Very few investors would turn up their noses at an opportunity to pick stocks like Warren Buffett. In the 56 years since he set up his investment firm, Berkshire Hathaway, its share price has risen by more than 3 million %. But Warren Buffett's criteria for investment success is no secret. The performance is testament to his mantra of buying great companies which can reinvest their earnings profitably over long periods of time. In this video, we'll show you how to use Stockopedia's tools to build a screen to help you identify Buffett stocks. First up, head to the sidebar and click New Screen. You can choose to give your screen a name now, or leave it until later if you'd rather. I'm going to name it now so it doesn't get lost. Warren Buffett screen. And now onto the rules. Stockopedia has many hundreds of rules in its screener, and you can either explore them by browsing through the lists here or by typing specific metrics. First of all, we're going to whittle down our investment universe a bit by screening out companies of a certain size and in certain sectors. These days, Buffett tends to pick larger stocks. His firm is so big that he has to. But private investors can benefit from their ability to invest in smaller companies. But I do want to remove the smallest and riskiest stocks in the market, so I'm going to screen for companies with a market capitalisation greater than £50 million. Buffett also often talks about the importance of being able to understand all businesses he invests in. And so for this screen, we've opted to exclude metals and mining, coal, and investment banking and investment services. If you're building your own Buffett screen, you can alter the sector choices to suit your own preference. Next, we'll look at one of Buffett's key requirements: businesses with above average profitability. Now, we've got a few options here for showing companies with a high return on capital, but the one we're going to pick is this return on capital as defined by another reputable US investor, Joel Greenblatt. The reason for picking this definition is because it more closely calculates the profits a company earns from its operations and fixed assets, which aligns with Warren Buffett's thinking. But you can choose a different metric for returns, return on capital employed or return on invested capital perhaps, if you're more familiar with them. Regardless, we're looking for high returns over the long term, so we'll specify a 5-year average and limit our companies to a 5-year return on capital of above 15%. For further assurance that we're selecting highly profitable companies, we're going to add a return on equity screen to ensure we're only selecting companies which are generating decent profits from the investments made by their shareholders. Again, we're looking for a 5-year average of more than 15%. But it's not just equity that we want to make sure that the company is using effectively. We also want to ensure we're picking companies that fund future growth using their own profits. Estimating a company's ability to grow in the future is difficult, but our tools can help you replicate Buffett's talent for identifying growing companies. Using the work of Warren Buffett's former daughter-in-law, we've created an expected return rule, which you can find by scrolling right to the bottom of the growth section of the screening tools. You want to make sure you have selected sustainable growth, and then in this screen, we've specified a minimum expected growth of 6%. To complement this, we've also used another rule to demonstrate a growth trend: 5-year compound annual earnings growth per share of at least 5%. Fourth, we acknowledge that Warren Buffett dislikes companies that rely on debt to generate growth. To avoid these stocks, we've screened for companies with a net gearing of less than 60%. We've opted to use the net gearing including pensions figure. The reasons being that if we use a gearing figure based on total liabilities, we might exclude a few too many companies. Remember that screening results are always a starting point for further investigation, not a final selection. And finally, valuation. Now, for pure quality investors, valuation is of less importance. And returning to our Buffett quote at the beginning, it's better to buy a great company at a fair price than a fair company at a great price. The question, though, is what is a fair price? Buffett and many other quality investors look for companies which have a market valuation below their intrinsic value, and to identify these, we've opted for 2 ratios. First, an earnings yield, which shows how much a company earns compared to its total market capitalization plus debt, otherwise known as enterprise value. We're looking for stocks with an earnings yield greater than 6%. And then enterprise value to free cash flow ratio, which looks at a company's ability to generate cash. Put plainly, the lower the ratio, the faster a company can generate cash to reinvest in its business. So here we're looking for a ratio of less than 25 times. So there we have it, the finished screen, providing a list of stocks which Warren Buffett might consider for his portfolio at Berkshire Hathaway. You can see from this screen that I've selected all international markets, so we might want to whittle this down further to only select stocks from certain more accessible markets. Just go back into your screen editing and add a criteria which allows you to see just stocks from only a handful of countries. Perhaps you just want to look for stocks in the UK. Or maybe you're feeling a bit more adventurous and you want to have a look for stocks in the US. And you can always play around with the rules of your screen. If you're not as focused on the value factor, you could always remove those metrics. But remember, this is just a starting point. Although we have whittled down the number of stocks to a manageable length, it's worth doing a bit more research on any promising companies before committing.